Hello everybody, again it's Cam from the Santa Sells Houses team, back with part 2 of our video series about what the current market is like for buyers, aka the buyer's market. Not really. Anyhow, what we're going to do today is compare the average experience today to an average experience that someone might have experienced earlier in the year, let's call it February. Alright, so first of all we're going to highlight two different scenarios. I've got February here and I've got September here. And I did the math, and these are real figures that were available to buyers in the market in February versus currently in September. Okay, so in February, our average home price, this is average across all segments of the market, was $820,000, give or take. These are nice round numbers. Now, the minimum down payment that you could make to buy that house in Canada is $57,000, all right? Which would leave you with a mortgage, including insurance. Keep in mind, this is not 20% down, so you have CMHC insurance on top of your mortgage balance. Was gonna leave you with a total mortgage just over $790K. The monthly payment here in February, you wanted to buy the average house with minimum down payment, $3,690 per month, okay? One key thing I wanna point out here, because this mortgage rate is so low, the mortgage rate is 2.89. That was available to people earlier this year. Because that mortgage rate, the interest rate is so low, over the term of the mortgage, which is 5 years in this scenario, this person paid back $117,000 in principal and $104,000 in interest, meaning they paid off $117K from that original loan and they paid less interest than what they paid in principal. That's great. Really low interest rate. Keep in mind, these rates are or were historically low, very uncommon, unlikely that we'll see that again for a very long time, all right? Let's fast forward to September, okay? Because a lot of the comments earlier this year from buyers were, I don't want to get into the market right now. I don't want competition. I don't want to pay these high prices. I'm going to wait for prices to come down, okay? So the difference here is $180,000. So the market has come down. This is the average house. Again, so we're gonna run with the same scenario, because if you're looking at buying a house in February, chances are you still have this available to you, okay? You've got $57,000 to make as a down payment. Now that's more than the minimum you need to buy this house, which is great. So you're gonna have less principal. Again, your mortgage, including CMHC fees, interest payments, insurance payments, is gonna total $606,000. Your monthly payment, and this is based on what is a current rate, fixed at 5 years, 4.89%. You're paying $3,489 a month. So basically from here to here, you've saved $200 a month, okay? It's actually a less payment than what you're gonna make, than what you're gonna pay here, okay? The key difference, this is the very key difference here. In this scenario, because your rate has gone up 2% from 2.89 to 4.89, over the term of 5 years, you pay down $70,000 in principal. You pay $140K in interest. All right, so this is switched. Here you're making a lot more payments towards the balance of your mortgage, which is great, more equity in your house, versus here. Again, keep in mind, 2.89% interest rate, we haven't really seen very often, if ever, before, okay? Fast forward 10, 20 years ago, mortgage rates were not 2.89%. 4.89%, much more realistic. When you look at the history of mortgage rates, what we're likely to see moving forward is going to be closer to this range than this. So this is typical. This is fairy tale land, okay? Understand that. This makes sense. This is a joke. Good? The important thing to understand here is, right now, a lot of people were waiting for prices to come down, and now that they have, they're saying, well, I don't want to pay that interest rate. I don't want to lock into that interest rate because I don't like the payment, and I don't like this contrast here. All right, again, fairy tale land, okay? The other thing to think about here is, what is your situation? Because chances are, if you were looking at buying a house in February and you had a down payment of $57,000 plus closing costs, and you decided, I don't want to buy right now, I'm gonna wait until September, this might have actually gone up. You might have more funds available to you in a down payment, okay? Which would make this even more attractive if you were able to save money. Again, people's down payment, depending on your scenario, is likely tied to, do you own a home? Do you rent? Do you live at home rent free? What does that do? Because if you already owned a home and this is the equity that you had in your house and the market's gone down quite a bit, your down payment might be gone. That's unlikely. I don't know many people in that scenario, but contrarily, let's say this was just sitting in a bank account, and let's say this was 130K. Now prices have gone down, and I can actually make more than a 20% down payment on this house. My payment's gonna go down even more because once you have that 20% down payment, you can move to a 30-year AM, stretch that loan out if you decide that's something you want to do. And in fact, this even becomes lower. So understand the power here, because this is big. If you were able to save up more, you're in a better position. If you were on the cusp of a 25-year versus 30-year AM, you're in an even better spot here. So understand, one, scary interest rates, not really. That's not where we're at yet. We're not at 8, 10, 12, 20% interest rates. That's not happening right now. This is still, okay, 4.89. Again, talk to any mortgage broker, any person that works at a bank. That is probably a realistic 5-year rate moving forward, okay? The other thing too, depending on your scenario, you might be in an even better spot than you were here, okay? The only losing situation here is if you were tied to this, thinking that you were gonna be paying off a ton more principal than interest in the first 5 years of your mortgage. Yes, that's a tough pill to swallow. But again, 2.89% 5-year fixed rate. I don't know when we'll see that again. Talk to your mortgage broker. They can tell you all about what they think is gonna happen there, okay? The other thing too, if you are banking on a large down payment from your house, let's say you owned a house and in February it was worth $600,000 and today it's maybe worth $450, all right? Round numbers, spitballing. If you owe $400,000 on that house, you went from $200,000 worth of equity to $50,000 worth of equity. So right now, moving to another house might not make a ton of sense, right? You might need to wait for the market to go back up so that you have that 20% down payment to go to the next house and get that 30-year AM. Again, the key points: mortgage rate, not scary. You're actually in a better spot on a month-to-month basis here. This is the reality that we need to get used to. 2, every situation is very individualized. Your scenario is different from the next person and the next person and the next 100,000 people down the line, okay? You need people that you can trust that are gonna give you good advice and help you make sense of what's going on here to kind of move forward, all right? So for buyers, this is the key lesson to understand here. And please, if you are curious about what your situation is like, what we think you should or might want to do moving forward, please reach out to us. We'd be happy to talk to you about the buyer's market as we see it at any point. Talk to you again tomorrow. We're going to continue our deep dive into the buyer's market for the fall of 2022. Cheers.